The Indian stock market lost nearly 15 lakh crore rupees in total market capitalization during a single trading session today, driven by a sharp escalation in Middle Eastern geopolitical tensions. This chart shows the Nifty 50's steep intraday drop, plunging over 600 points to close at 22,512. The broader market damage extended to the Sensex, dropping 1,930 points, while Bank Nifty fell over 2,080 points. This broad sell-off pushed the India VIX up by more than 15%. The VIX is a volatility index measuring expected near-term price fluctuations. This severe spike indicates a strict risk-off sentiment among global investors, which rapidly broke through crucial technical support levels. The sheer volume of wealth destroyed in a single day points directly to external, non-financial catalysts, forcing immediate liquidation across portfolios, separating this decline from standard market corrections. The primary catalyst for the sell-off was a 48-hour ultimatum issued by the United States to Iran regarding the Strait of Hormuz. Iran retaliated with ballistic missile strikes targeting a U.S. base in the Indian Ocean. This chart tracks the immediate impact on global energy markets. Brent crude prices violently spiked upward, crossing the $113 per barrel mark as traders priced in immediate supply disruptions. Because India imports the vast majority of its oil, higher energy costs place immediate pressure on the domestic currency. The Indian rupee hit a fresh lifetime low today, crossing the 94 mark against the US dollar. This chart visualizes foreign capital movement in the Indian market. Foreign institutional investors, or FIIs, have aggressively accelerated their exit to seek the relative safety of the US dollar. In March 2026 alone, FIIs pulled out over 1.03 lakh crore rupees. The combination of $113 oil, a weakening rupee, and massive foreign capital flight creates a compounding macroeconomic threat. Together, these three metrics point toward a rapidly widening current account deficit and a looming spike in domestic inflation. Domestic-facing public sector banks and energy-reliant metal companies absorbed the heaviest blows today. Both the Nifty PSU Bank and Nifty Metal indices dropped roughly 4%. Individual stocks driving the index downward included Shriram Finance, which fell 6.5%, followed closely by major metal producers like Tata Steel at -5.2% and JSW Steel. This heat map shows the exact distribution of market performance. In sharp contrast to the deep red banking and metal sectors, defensive pockets like IT showed marginal resilience, while upstream energy companies like OMGC actually posted gains from the crude price surge. The clear divergence between crashing domestic sectors and resilient energy and IT stocks indicates that institutional investors are actively executing aggressive defensive portfolio repositioning. The Indian government deployed countermeasures to address the oil shock. Prime Minister Modi announced 6.5 million metric tons of additional petroleum reserves. State communications further attempted to stabilize sentiment, reinforcing India's solid economic foundations and confirming adequate fertilizer supplies. At the corporate level, major entities took steps to mitigate shareholder panic. Companies like Vedanta and HUDCO announced interim dividends, aiming to provide immediate cash returns to nervous investors. This chart outlines the technical reality currently facing investors. The Nifty has decisively broken the crucial 22,800 support level, shifting the broader market into a strict sell-on-rise mode. Unless there is an explicit de-escalation of military tensions in the Middle East, technical models project an unavoidable continued slide. The market is now looking at 22,200 as the next major support floor.